Welcome back. You're still tuned into Chartbusters on CNBC-TV18. Well, let's talk about the big stock in focus, which is Jupiter Lifeline Hospitals. It's made a strong debut on the exchanges, listing with a gain of around 32%, but now around 43% higher. We have with us Ankit Thakker, the CEO of Jupiter Lifeline Hospitals, joining in to discuss the company's post-listing plans. Ankit, hi, welcome to the show, and congratulations on what is a strong listing. In fact, another strong listing from the entire hospital space. Wanted your thoughts, Ankit, with regards to revenue growth, considering that now you would have a freer hand to talk about forward-looking numbers post the listing. You did around 20% growth in the previous fiscal, and you have recovered from COVID levels as well. But what is growth looking like going forward, considering that you are focused on micro markets where there is lesser amount of competition there? Do you think that you can probably augment this 20% growth, or is this a sustainable level we can look forward to?
Thank you for having me, and thank you for the wishes. Going forward, as we met last time, and I was telling you, was that our thought is that in the existing hospitals, that is Thane, Pune, and Indore. Pune and Indore still have a significant headroom for growth in terms of capacity utilization. So we believe that in the next couple of years, we should see respectable growth numbers coming in from the Pune and Indore hospitals. And Thane hospital, being relatively mature, should see a little bit more of an inflation-linked kind of growth. In the business model that we operate in, where we choose to have full asset-heavy businesses, hospitals, greenfield projects, the new growth essentially will come from new hospitals once the older ones are fully matured. So that is the outlook. Dombivli Hospital, which is a 500-bed hospital, again, like you said, in the micro market, which does not have too much of other providers, will come up in 2 to 3 years, and then that should contribute for growth.
All right, Ankit, first of all, congratulations on a solid listing. The last time you had to be a little bit guarded. That was listing. But now you can be a little bit more vocal. So give us a few details. I recall you were telling us that you're looking at scaling capacity from 1,200 to around 2,500 beds. The capex, I think, roughly we're working with 1 crore per bed. So now you're going to be debt-free, right? How do you fund this expansion, and how much of this additional capacity is already in your capex plan that's already accounted for?
Correct. Thanks, Nigel. So, yes, you are right that we are wanting to pretty much double up from close to 1,200 to 2,500 odd beds. 500 beds, as I was just saying, are coming up in Dombivli, which will take us to 1,700 number. The plan is around 1 crore a bed for that project. Going forward, we want to do 2 more maybe hospitals, given that our model is 300 to 500 beds, to just simplify it and work with round numbers. If 2 more 400-bed hospitals come in, it takes you to the 2,500 bed mark. So that is the growth plan over the next 4 to 5 years. In terms of capex, you remember correctly that we are using our IPO proceeds to pay off our debt. So we will be fully debt-free very soon. What that means is that we would have, more free cash available in hand, and the gap between EBITDA and PAT and EBITDA and free cash will really shrink, and it will leave more money in our hands in order to plow back into capex. Because we are not into M&A mode, this is a better way of for us to grow. We don't need all the money on day one, but getting more free cash month on month will help us to reinvest it to build the new capacity.
Okay. Well, Ankit, what I wanted to know is that you do not have any plans of expanding beyond micro markets. That's going to be your strategy going forward as well. So what is the occupancy that you could probably scale up to on a sustainable basis, considering that Thane is at around 70%, Pune is at mid-50s, and Indore is at 40. So based on the markets that you operate in, what is a blended occupancy that you can work with or you can guide investors with, as well as an increase in average revenue per occupied bed? how much pricing power do you have in these markets, both these parameters on a sustainable basis?
So on the occupancy side, I think anything between 75 to 80% can be sustainable as a peak occupancy. I think it is not realistic to expect more than 80% on a continual basis as an average sustained occupancy for any of the hospital. So we believe that all the hospitals that we have built have that potential to reach those occupancy levels. As far as ARPOBs are concerned, on a blended level, I think last year we closed at 50,000 odd something of ARPOBs. Again, ARPOBs are a function of two things. The geographies where you operate and the quality and the kind of services that you provide. And it was interesting that you pointed out about pricing power. I think, you have to be realistic that in a world which is competitive in nature, no one really has 100% autonomy on pricing, and you will have to play in the landscape where you operate. So, so yes, I am cognizant of that fact. And that is how we will look at it.
Okay. All right, Ankit, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So it is definitely a great listing for Jupiter. But, Nigel, I just want to point out all of the recent hospital listings have done absolutely fabulously simply because there's so much interest in the market. And we're not only talking about the listed space, we're talking about even the unlisted space, which has seen PE deals flood through.
Yeah.
If it's specialty businesses, if it's Medanta, if it's an eye hospital, if it's an IVF clinic, there's a lot of interest, which is all in all coming into the healthcare space.
All right, well put, Ekta. That's true. And in fact, the returns are up for you on the screen as well. For the time.